Well, Mad Money was being preempted by the Winter Olympics in Sochi, curling to be precise, over the past couple of weeks. Something big happened. The hideous winter weather here in the United States caused the price of natural gas to spike up to the highest levels in 5 years, one point rising above $6 per million British thermal units, or BTUs. Some of this is obviously temporary. Witness today's big decline in nat gas. But for years now, we've had a horrendous natural gas glut, and the recent action tells us that the glut might not be as endless as it seemed. So tonight I want to introduce you to a high-quality natural gas producer, one that only just came public a month ago. I'm talking about Rice Energy, RICE for you home gamers. Here's a company that gets all of its current production from 44,000 terrific acres in the southwestern Pennsylvania area of something you're all familiar with from watching the show, the Marcellus Shale. And right now the stock is valued as though that's the company's only acreage. Rice also has 47,000 acres in Ohio's Utica Shale. Remember, we went there with Chesapeake. And they're currently drilling aggressively. In other words, maybe you're basically getting the Utica holdings for free. Rice came public at $21 per share a month ago. IPO was a little less sexy than many of the others we've seen lately, stock opening up 4.3% in the first day of trading. Since then, though, the stock's rallied more than 10% in the aftermarket. Rice has been a very low-cost driller in the Marcellus, with drilling and completion costs of just 70 cents per 1,000 cubic feet of proved reserves. And if they can duplicate that in the Utica, then this stock could have a lot more room to run, even if natural gas prices fall dramatically from the current elevated levels, which I think you have to expect given the winter's warm. Winter does end. Let's check in with Daniel Rice, the CEO of Rice Energy, learn more about his company and its prospects. Mr. Rice, welcome to Mad Money. How are you?
Thanks, Jim. Thanks for having me.
Oh, sure. Have a seat. Okay. A few months ago, all we wanted was oil. Now all we want is natural gas. How do you know I'm not going to shift right back to wanting oil and send Rice Energy down?
Sure. When we founded the company, we were really agnostic to commodity mix. I think what we were really looking at was rate of returns that we're getting on our investments. Okay. And so for us, we're really focusing within the Marcellus in an area that has break-even prices for our wells around $2 to $2.50 per MCF. We've been able to identify the same type of qualities in the Utica Shale acreage that we have as well. And so just given where the future prices are for both oil and natural gas, we're pretty well positioned in an area that we think is going to be pretty economic for years to come.
Why is your productivity so high? Because you're up there with Capital Oil and Gas, which we've liked for a long time, and EQT.
Sure. I think one of the things that really makes our company different is just our approach to the shale. I think one of the things the industry as a whole has really learned over the last few years is how sensitive the shale is to development. And so the unique approach that we take in terms of the technology and processing that information, we're making really little changes to the shale in our development that's really optimizing our rate of returns on these wells. So right now we have about 40 wells producing over 200 million a day of production, which is really illustrative of how prolific the shale can be if it's done the right way.
Okay, we've had pretty good success with these stocks, and whether it be EOG or whether we've liked Cabot, we've liked Anadarko at times. Most of those companies have management been around for a long time. Even Magnum Hunter, which had ups and downs and now ups. You're 33? Mm-hmm. And not a long history in this group. So why should we bet on you, and especially given the fact that you do have a leveraged balance sheet if you could do all this drilling?
Mm-hmm. Yeah, that's a really good question. I think if you take a step back and you look at shale in general, shale has really only been around since the Barnett in the early 2000s. Right. So it's only really been around for 10 years. I think if you look at the management team that we have and our track record, it's been 100% within shale. And so our technical folks, the engineers, they grew up in the Barnett, in the formation of the Barnett. So we've designed this company specific for shale development. And so I think if you tried to ask somebody, do you have 20 or 30 years in shale? The answer can be a maximum of maybe 10, 12 years.
Okay. Aubrey McLennan's someone who now in private life, but we visited him in the Utica, and the Utica, frankly, was disappointing. He felt it would have a lot of oil, didn't really have it. Utica's been somewhat good, somewhat bad. Why should we care? How much is Utica really worth on top of Marcellus?
Yeah, I think if you look at the Marcellus, I think people have started to identify and really validate where the sweet spots are. Mm-hmm. I think with the Utica Shale, people were hoping it was going to be the second coming of the Eagle Ford Shale down in Texas. They want something that was really oily, liquids rich, and really prolific. I think what we've ended up with in the Utica is a narrow liquids window, but a very, very prolific dry gas area.
Okay, do you think that natural gas has to go to 6 to be able to take care of the capital flows that you need? Because you are levered. And that's worrisome to me because natural gas slips back to 3. I know you're hedged on more than half for next year, but your capital program won't work if natural gas goes down a lot.
Yeah, I think if you look at our capital program, it's important to be able to bifurcate our drilling and completion capex, which drives the producing cash flows, versus the other longer-term investments we're making on both the land side and on the midstream side. Those are more or less just one-time upfront investments to really support future growth of the production.
But are you going to have to borrow a lot of money?
No, not necessarily. I think if you look at a company like Cabot, they're a fantastic example of a company that is free cash flow positive and is able to grow their production year over year. That's kind of a nirvana for E&P companies. And I think if you look at the quality of the assets that we have, we've demonstrated that these wells pay out within 12 months, which is certainly a quality you need for being free cash flow positive. But for us, we're making these long-term investments today. And that was part of the impetus for going public, is give us the capital to make these long-term investments to really plan for the next 10 to 15 years of development that we have on our acreage.
Excellent. Okay, well, that's Daniel Rice, CEO, Rice Energy. Brand new company, young management, great Marcellus Holdings. Stay with Cramer.